Hello, dividend growth stock investors. Happy Sunday and December 1st to you. Hope everyone has been really enjoying their Thanksgiving holiday weekend. My name is Colby, the DGI Crab, and I usually do a Friday video covering stocks in the DGI Crab portfolio that appear to be undervalued. Schedules were a little bit different this week. I hope that you don't mind bearing with me. But here we are on Sunday. I thought we'd go over that here today. And it's always good to make a plan going into the following investing week so you already know what stocks are looking appealing for your age range. If you're new to the channel, I cover 60 high-quality dividend growth stocks split into 4 separate categories based on age and time horizon, the most important metric for a dividend growth stock investor. Now, I'm not a professional financial advisor. The content of this channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. So, what is my personal allocation strategy? Well, the DGI Crab strategy is a minimum 50% of new money goes into age-appropriate ETFs for automatic diversification, and I'm looking for stocks that are yielding 30% or more above their 4-year average yield. My top 10 favorite stocks, however, I will buy if they're yielding just 20% above their 4-year average yield because I just love them that much. I will remain within my personal tier unless there's a stock in a different tier yielding 50% or more above the 4-year average. And if there is not a buyable stock that meets my criteria within my tier, then I will just simply add more money to ETFs for that particular week. Stick around to the end of the video and I'll show you exactly what I invested my money into in the DGI Crab portfolio this week. So we're going to go into the spreadsheet, as always, into the tiers, where we'll start with Tier 1, age 18 to 30-year-old investors, where we are looking for preferably a 1 to 2% starting cumulative yield and a growth rate of 12% or better if we can get it. Nike remains the most undervalued stock within this tier, well above the 50% undervalued range. So Nike is a stock that I think looks very buyable in most any other tier, also still yielding just a clip above 2% at current day prices. And the 4-year average yield has gradually ticked up over the last few months, but still just at 1.13%. So we're getting that valuation metric of a 79.75% undervalued. I have been preaching Nike for months now as a very undervalued stock. Eventually, this will not be an undervalued stock. Something else in this category will go through some tough times and be in that buy zone range, and Nike will recover. I'm very, very sure of it. But for right now, it remains to be open season with Nike buying, in my personal opinion. I love getting Nike at a 2% or better yield. I think that's a great deal. Tier 2, the 31 to 41-year-old investors. I'm recently 41 and will be in this category for another 11 months now. We're looking to get a starting yield in the 2 to 3% range with an annual growth rate in the high single digits. Hershey and Target are the most undervalued stocks in this particular tier. Hershey's been down in the dumps for quite a while now, also above that 50% mark. So another one that's open season for an investor of any age. Hershey yielding above 3% is a deal I cannot get enough of. The 4-year average yield on Hershey you'll see here is just 2.02%, currently yielding at 3.11. Love it. Target, about a week and a half ago, dropped as low as $120 after badly missing earnings in their last quarter, but they have recovered and climbed back up to $132. Still a fine deal, yielding well above 3%, almost 3.4%, 2.3% 4-year average yield means that this dividend king is on sale after reporting bad earnings. McCormick, did a dividend increase within the last 30 days, and they're so close to the buy zone, but not quite there yet. I need them to get just a little bit cheaper than 78.41, but McCormick is certainly one that I'm going to have my eye close on. If it dips down too much further, it's going to fall into my buy zone. It might be one that I add a little bit to next week. We'll just have to wait and see what it does. Tier 3 for the 42 to 53-year-old investor, where we're looking for 3 to 4% average starting yield with a growth rate in the mid to high single digits. Archer Daniels Midland remains easily the most undervalued stock in this category, eclipsing once again that 50% above the 4-year average yield, 2.42 average yield with a current yield of 3.66. Another one that I just can't get enough of, extremely high quality stock and company, not doing so well reporting their financials, and they're getting punished for it by the market. But I'm happy to add to Archer Daniels Midland while it is cheap. This is a stock I'm used to seeing in the $70 to $80 range, and this year being down in the 50s and low 60s has been much more common. Hormel recently did a dividend increase, a small one, but an increase nonetheless, keeping their long, almost 60-year streak alive with the dividend increases. It's been a very bad year for Hormel. There's not a lot of great news as far as what's going on with the company and the numbers and everything else. However, they've been through tough times before. Over the course of 57, 58 consecutive years of dividend increases, Hormel's been a downtrodden stock here and there. It's been a high flyer also. Right now, still trading very cheap, but as the 4-year average yield continues to creep up, the longer Hormel remains down here, the valuation of the current price that it's at gets slightly less attractive, but still very much in my buy zone for the Tier 3 investor. And even though the dividend increase they just announced was small, I'm very encouraged by it because it shows that management, even with a conservative increase, is interested in continuing to keep that streak alive, and they're just playing it very safe right now, not getting out over their skis with paying out too much in dividends, and hopefully in the coming years they'll be able to get back to a more normal range of dividend increases by their own standards. And then Pepsi, one of my top 10 favorite individual stocks, one of the ones that I will purchase if it is 20% or more above the 4-year average, remains right there, 20.58% undervalued, a 4-year average yield of 2.75%, currently yielding 3.32%. Very happy to add Pepsi right now. I don't wait for Pepsi to get a whole lot cheaper than this. I want to jump in and grab it when I can. I'm also keeping a very close eye on Johnson & Johnson, also in that top 10 category. Starting very, very close to getting into my buy zone. It's been flirting with it for a few weeks now, but hasn't quite got there yet. But I'm keeping a very close eye on J&J. How about you guys? Tier 4, age 54 and older investors, where we're looking for at least a 5% starting cumulative yield. And not throwing growth rate out the window, we still want to get 2, 3, 4% a year. So that way, even when we're living off of the dividends that these high yield investments generate and we're not reinvesting them anymore, we'll still get some raises just so you can keep up with inflation. Realty income has been the number one in this category for quite a while now, but not cheap enough for me to be excited about buying it at this point in time. Still waiting for a deal to happen with these high yield investments, but these high yield stocks have been doing really, really well this year. They seem to be very popular, and people are just buying them up, and they are not they're not losing their value at all this year. So I'm going to be patient on these. I'm going to stick more to high-yielding ETFs in this category as opposed to being risky purchasing an individual single stock that just doesn't look like it's trading cheaply at this point in time. Quick swing by the top 10 stock tabs. So all of 10 of these stocks can be found somewhere in tiers 1, 2, or 3. I keep them on their own separate tab just so I make sure I keep a very close eye on them. Feel free to pause the video and review the numbers on these if you like. But for right now, Pepsi's the only one in my buy zone. Johnson & Johnson's very close. And if I can get them yielding at all higher above their 4-year average, like Coke, Union Pacific, McDonald's, are all yielding slightly higher than their 4-year average, they're not terrible purchases by any stretch. If you're wanting to build up a position in these companies, it's not the worst time in the world to do so, but I'm probably still going to wait until they get a little bit cheaper before I personally am going after any of them. So what the strategy looks like for the week, just so you can get an idea. As I said, 50% of new money goes into ETFs for automatic diversification. For the tier 1 investor, I tend to favor the S&P 500 as the primary ETF, putting 25% of new money in there, and then 15% of money into a small cap value, so I get plenty of exposure to the small cap market. A little bit into a dividend growth like VIG or maybe DGROW if you like that one better, and 5% into an international dividend ETF, of which VYMI is my favorite. If you've been here for a while, you know I love VYMI. I put 5% of money into VYMI. It's the only non-US investment that I have. Tier 2, I do the same for ETFs, but with a different weighting. 25% goes into the dividend appreciation, 15% S&P 500, 5% small cap. And then tier 3, I like higher yielding but still quality growing ETFs like VYM, SCHD, or DHS. I would probably split my money between the three because they have different strategies and I just really like them all. But you could also just put 45% of your money into just one of them. If you're an SCHD head, a lot of people like that one. That's perfectly fine as well. And then for tier 4, a larger amount of ETFs with some alternative investments. SPYD I like for stocks in this category. Big companies, high yield, steady, stable, boring, but that's what we need in this particular category. And then I go 5% high yield bonds, 5% preferred shares, 5% MLPs, 5% each into Devo, JEPI, and SPYI for monthly covered call strategy income, and then 5 international. And for the individual stocks, a lot of stocks that could be purchased in the first 3 tiers. So for tier 1, I'm going to do 25% Nike, the only super undervalued one in tier 1. I'm going to do 10% Pepsi to get to the top 10 stock in my list. I'd go ahead and start adding into that. And then 5% each into Target, Hershey, and Archer Daniels Midland, the 3 other stocks that are 50% yielding 50% higher than 4-year average. For tier 2, I'm doing 15 each into Hershey and Target, the best 2 in that category, 10% Pepsi, and then 5% Nike, 5% ADM, the tier 1 and the tier 3, 50% or more undervalued. Tier 3, my biggest one is actually going to be Pepsi, since Pepsi's actually in the tier 3. I'm going to go 15% there while splitting 10% each into Archer Daniels Midland and Hormel, and then 5 each into Hershey, Target, and Nike. So obviously I really like that collection of undervalued stocks pretty much across the board. And then for my tier 4 investors, once again, I'm going to be doing ETF double down. Instead of 15% and 5s down the board, I'm going to do 30% with 10s down the board. Except for VYMI, I keep international at 5%, and man, I would personally pick Pepsi at this point in time, even for the tier 4s. You're getting 3.3% on a stock that's going to grow that dividend very consistently. And then here is what I did for DGI Crab portfolio. I did another $100 into it this week on that Fidelity account I opened recently. And I split it out exactly as I showed you in the tier 2 category. It was 25 VIG, 15 VOO, 5 each into VBR and VYMI for the ETF distribution. And then 15 Hershey, 10 into Pepsi, 15 Target, 5 ADM, 5 Nike. Cumulatively, that added $2.52 of forward dividend income. So that was how it looked for me this week. Let me know what you all bought below and what you're looking at next week. I'll see you on the next one, you guys. Thanks so much for watching.